Every generation of investors faces the same temptation, to believe that this time is different. New technologies, new markets, new opportunities, and yet, beneath the excitement, the laws of value remain unchanged. That's where Benjamin Graham's wisdom becomes more than history. It becomes a guide for anyone trying to invest intelligently, no matter the era. When I first encountered Graham's writings, what struck me most wasn't his equations or formulas. It was his method, his insistence on clarity and discipline before every decision. Graham never acted on a hunch or a tip. He approached investing like a scientist approaches an experiment, with preparation, logic, and a checklist. Before he would buy a single share of stock, he demanded that it pass through a series of filters, each designed to protect his capital and ensure that his decision was rooted in facts, not feelings. This checklist, though never printed as such, was embedded throughout The Intelligent Investor and Security Analysis. It represented the essence of his philosophy, a way to separate true investments from mere speculations. And the beauty of it is that the same process still works today, even in a world of algorithmic trading and social media hype. Because while markets evolve, human behavior doesn't. The same emotions that drove the speculative manias of the 1920s drive today's frenzied rallies in meme stocks and tech IPOs. Graham's method wasn't designed to beat the market in a week. It was designed to protect the investor from himself and to build wealth patiently, intelligently, and safely over time. In this lesson, we'll walk through Graham's timeless checklist, step by step. We'll uncover how he analyzed a company before buying, how he defined safety, and how he knew when the price was right. Along the way, we'll see how his principles from nearly a century ago still guide the most successful investors today, from Warren Buffett to patient, everyday value investors who follow his philosophy. Because Graham didn't just teach how to make money, he taught how not to lose it. And that is the foundation of intelligent investing. But before we look at the numbers and ratios, Graham always began with something simpler and far more important. He started with understanding. He asked a question that too few investors ask today. Do I truly understand the business I'm about to buy? Graham's first rule was never to treat a stock as a ticker symbol. It is not just a line on a chart or a number moving up and down. It represents ownership in a real business. And before owning any part of that business, Graham insisted on understanding what it actually did, how it earned money, and whether its economics were sound. This might sound obvious, but in practice, it's where most investors fail. Even in Graham's day, many speculators bought shares in companies they couldn't describe in a single sentence. During the roaring 1920s, for instance, Wall Street was flooded with flashy investment trusts, many of which pooled money into unknown ventures with vague promises of prosperity. People poured in fortunes without ever reading a balance sheet. Graham saw it firsthand and watched as these same investors were wiped out when the crash of 1929 revealed how little substance many of these trusts actually had. So his first step in stock analysis was always know what you own. He would study the company's business model, its industry position, and its competitive advantages, what he called economic moat, long before that phrase was popularized. He wanted to see that the company's profits were based on something durable, not a passing trend or fad.
If Graham were alive today, he would apply this same scrutiny to the tech startups, electric vehicle makers, or fintech companies that capture headlines. He would ask the same simple, piercing questions. What problem does this business solve? Who are its real competitors? And how does it make consistent money, not just revenue growth or hype? He was wary of businesses that depended too heavily on unpredictable factors, like commodity prices or a single major customer. In Graham's view, a business should be understandable enough that its future could be estimated within a reasonable range. As he once wrote, "An investor's worst enemy is not the market, but his own ignorance of what he owns." Warren Buffett would later summarize this principle perfectly when he said, "I only invest in businesses I can understand." That's pure Graham. Understanding gives the investor confidence to hold steady when others panic, and the clarity to recognize when a stock's price is divorced from its true value. Once Graham was satisfied that the business itself was solid and comprehensible, he moved to the next stage of his checklist, analyzing the company's financial foundation. Because a great story means nothing without sound numbers behind it. And for Graham, those numbers told a story of their own, one about stability, solvency, and the strength to survive tough times. To Graham, a company's balance sheet wasn't just a collection of figures, it was a reflection of its resilience. He believed that before looking at profits or growth, an investor must first ask, can this company survive hard times? This belief came from experience. During the Great Depression, Graham watched countless companies crumble, not because their products were poor, but because their finances were fragile. They had borrowed too much, held too little cash, or expanded recklessly during boom years. When the economy turned, those weaknesses were exposed, and shareholders paid the price. That's why Graham's checklist began with balance sheet strength. He paid close attention to three elements: liquidity, debt levels, and tangible assets. First, liquidity. Graham liked to see a current ratio, current assets divided by current liabilities, of at least 2 to 1. This meant the company had twice as many short-term assets as it owed in the near term. It was a simple but powerful measure of financial breathing room. Next, debt. Graham was skeptical of high leverage, particularly for industrial companies. He wanted total debt to be comfortably manageable relative to assets and earnings. In his view, debt was like oxygen, essential in moderation, deadly in excess. The investor's job was to ensure that even in a downturn, the company could meet its obligations without resorting to desperate measures like issuing new shares at low prices or selling key assets. Finally, tangible assets. Graham preferred companies with real, measurable value on their balance sheets, factories, inventory, or property, not just goodwill or speculative intangibles. This focus reflected his deep belief in a margin of safety. Tangible assets provided that margin, serving as a cushion if earnings fell or if the market turned pessimistic. To illustrate this, consider one of Graham's favorite types of opportunity, the so-called net-net stock. These were companies whose market value fell below their net current assets, that is, the cash and receivables minus all liabilities. In simple terms, the market was offering the business for less than its liquidation value. Graham saw these situations as the ultimate proof of his philosophy. When you could buy $1 for 50 cents, the odds were in your favor, provided the company wasn't on the brink of collapse. Now, in today's markets, pure net-nets are rare, but the spirit of the idea remains vital. Look for companies whose financial strength and assets offer a built-in cushion against downside risk. Even in our era of intangible-heavy businesses, the principle still applies. A strong balance sheet gives investors time and flexibility when others are forced to act hastily.
Graham's students, like Buffett, took this principle to heart. They learned that no matter how promising a business might appear, it's never worth investing in one that can't endure adversity. Once financial strength was confirmed, Graham turned his attention to the next critical piece of his checklist: the company's earnings power. Because even the strongest balance sheet means little without a proven ability to generate consistent profits. And for Graham, the true measure of value always began and ended with earnings. For Graham, the story of a company's worth was told not in a single quarter or even a single year, but across a decade or more. He believed that earnings should be viewed like a moving picture, not a snapshot, because any company can look impressive for a moment, but only a few can stand the test of time. In security analysis, Graham often emphasized a minimum of 7 to 10 years of earnings history. This, he said, separates the temporary winners from the enduring enterprises. A firm that consistently earns profits across various economic cycles, through booms, recessions, and crises, demonstrates something far more valuable than short-term growth: durability. In the 1930s, many companies dazzled investors with spectacular earnings right before collapsing when the economy turned. The lesson was burned into Graham's philosophy, that apparent growth could be fleeting, and normal earnings were what truly mattered. He had a method for this. He preferred to use average earnings over several years rather than the latest figure. This smoothed out the noise of temporary ups and downs, revealing the business's real earning power. If a company earned $2 per share one year, $6 the next, and nothing the year after, Graham wouldn't be fooled by that $6 spike. He'd average the figures, assessing what the company earns in a typical year, because that's what sustains its value over time. To modern investors, this approach feels refreshingly grounded. In an age when quarterly reports dominate headlines, Graham's insistence on long-term averages reminds us that patience is a competitive advantage. Take, for example, a company like Procter & Gamble or Coca-Cola. Businesses that have been through wars, recessions, and inflationary periods, yet continued to deliver stable profits decade after decade. This kind of consistency would have immediately attracted Graham's attention, not because it's exciting, but because it's reliable. And in his world, reliability was worth more than excitement. But Graham didn't just stop at past performance. He demanded that investors question whether those earnings were genuine and sustainable. He warned that reported profits could often be distorted by accounting practices, one-time games, or even managerial optimism. He advised looking beneath the surface, adjusting for non-recurring items and focusing on the quality of earnings, not just their quantity. For instance, if a company sold an asset and reported a large gain, Graham would exclude it from his analysis. Temporary windfalls, he wrote, are not a substitute for permanent earning power. In other words, don't confuse luck with skill. The modern version of this principle applies just as strongly today. When a tech firm reports record profits thanks to a sudden boom in demand or a cost-cutting spree, a Graham-minded investor asks, can this level of profitability persist, or is it temporary? Is this real earning power or just noise? This insistence on viewing earnings through a lens of realism protected Graham and his followers from the seductive narratives that often accompany bull markets. While others were dazzled by rapid earnings growth, he looked for the quiet, consistent compounding of sound businesses. And yet, he went even further. For Graham, understanding earnings was only half of the equation. The other half was the price you pay for them. After all, even the best company becomes a poor investment if bought at the wrong price.
And that's where his next principle, valuation, became the cornerstone of his entire checklist. Because to Graham, knowing what a company earns means little unless you can measure whether its stock is cheap or expensive compared to those earnings. And he had a remarkably practical way to do just that. Graham's next checkpoint was valuation, the delicate bridge between a company's intrinsic worth and the price investors are willing to pay for it. To him, this was where investing became both an art and a science. He would often say, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. The word adequate was not accidental. Graham never sought the most exciting stock. He sought the one that offered value with a cushion of safety. To measure this, he focused on the relationship between price and earnings. The concept may seem simple today, but in Graham's time, it was revolutionary. He compared the market price of a stock to the company's average earnings over several years to determine whether investors were paying too much for too little. If a company's stock traded at 10 times its average earnings, a P/E ratio of 10, Graham would consider it attractively priced. If it traded at 20 or 30 times earnings, he saw that as speculation, not investment. His logic was straightforward. Paying a fair or low price relative to earnings gave investors a built-in margin of safety if the future turned out worse than expected. One of Graham's most famous valuation formulas appeared in the later editions of The Intelligent Investor. It was his simplified way of estimating the fair value of a stock, using a company's earnings per share and expected growth rate. The idea wasn't to calculate an exact number, but to anchor investors in rational expectations rather than emotional impulses. His formula essentially told investors, the faster the company grows, the higher price you can justify, but never beyond reason. He also introduced a concept that remains timeless, the distinction between value and price. Price, he explained, is what you pay. Value is what you get. The market, driven by emotion, often confuses the two. Graham's job, and the investors, was to separate them. During the speculative boom of the late 1920s, he witnessed companies trading at astronomical prices, detached from their actual earnings power. When the crash came, those illusions vanished overnight. This memory anchored Graham's thinking for life. He understood that no matter how impressive a company's story sounded, it could never justify paying more than the underlying value warranted. Now, in the modern world, investors have access to endless valuation metrics, discounted cash flow models, EV/EBITDA ratios, and so on. But Graham's approach still cuts through the noise. His method is built on one timeless question: does the price give me enough safety against disappointment? Let's bring this to a current example. Imagine two companies. One trades at a price-to-earnings ratio of 12, another at 40. The first is a stable business with moderate growth. The second is a fast-growing technology firm. Graham would likely gravitate toward the first, not because he disliked growth, but because he distrusted certainty in forecasts. He knew how often the market overestimated what would last and underestimated what was already proven. This principle was perfectly captured in one of his most powerful ideas, that of the margin of safety. To Graham, this wasn't just a mathematical buffer, it was a mindset. It meant buying with enough discount from intrinsic value so that even if your estimates were slightly wrong, and they almost always are, you still wouldn't lose much. It was the ultimate protection against both error and emotion.
He likened it to building a bridge strong enough to hold far more weight than you expect to carry. The engineer, he said, does not design a bridge to carry only the exact expected load. He builds it to withstand much more. In the same way, an investor should never buy a stock only because it seems fairly valued. It must be undervalued enough to account for uncertainty. But how did Graham actually find such undervalued opportunities? What practical signs did he look for before deciding that a stock offered that elusive margin of safety? That takes us to the next step in his checklist, one that bridges financial analysis with human behavior, evaluating management, and understanding the qualitative side of value. To Graham, the numbers told a story, but not the whole story. A company's management, its integrity, and its treatment of shareholders were the human threads woven through every balance sheet and income statement.
He understood that even the soundest business could be undone by poor leadership or reckless capital allocation. So the next step on his checklist was to evaluate management, not through charisma or personality, but through evidence of discipline and integrity. In Graham's day, financial disclosures were far less transparent than they are now. Annual reports were often vague, and managers could easily manipulate figures to paint a rosier picture. Graham learned, through hard experience, to distrust promises and focus instead on patterns. He asked, "Does management act in the interest of shareholders? Do they reinvest wisely or chase growth for its own sake? Are they conservative in their accounting, or do they stretch numbers to meet expectations?" He favored managers who treated earnings as belonging to shareholders, not to themselves. Companies that consistently paid dividends from real profits rather than inflated earnings earned his respect. On the other hand, when management reinvested every penny into expansion without producing better returns, he considered it a red flag. As he put it, the investor's chief problem, and even his worst enemy, is likely to be himself. But often that enemy also took the form of overconfident executives steering a company toward peril. One of Graham's best-known examples came from the 1930s, Northern Pipeline Company, a subsidiary of Standard Oil. The company was rich in liquid assets, but neglected by management, which preferred to hoard cash rather than distribute it to shareholders. Graham saw this as a hidden opportunity. He bought shares, urged management to pay out dividends, and eventually succeeded in unlocking significant value. It was a perfect demonstration of his approach, spotting value where others saw stagnation and using logic, not emotion, to act decisively. What's striking is how relevant this remains today. Modern investors often fall in love with visionary CEOs or charismatic founders, assuming that strong personality equates to sound judgment. Graham would have cautioned against this. He would ask, what do the numbers reveal about how management allocates capital? Are they buying back stock at sensible prices or at inflated levels just to boost earnings per share? Are they issuing shares to fund acquisitions, diluting owners in the process? In Graham's philosophy, management quality wasn't about flair, it was about stewardship. The goal was to find businesses where management viewed shareholders as partners, not obstacles. He placed a premium on conservatism, prudence, and honesty. For him, the best management teams weren't the ones making headlines, but those quietly creating enduring value. Today, with corporate transparency and instant news, we have far more tools to judge management than Graham ever did. Yet the principles remain the same. A company's character is reflected not in its press releases, but in its consistent actions, in how it earns, saves, and returns capital.
Once Graham had analyzed a company's finances, earnings, valuation, and management, he arrived at his final step, one that tied every principle together, ensuring that each investment offered a sufficient margin of safety. This wasn't merely a rule of thumb for him. It was the central pillar of all intelligent investing, the final test before buying any stock. And it is in this principle that the timeless essence of his checklist truly comes alive. For Graham, every analysis, every calculation, and every question ultimately led to one decisive moment. Would this investment still make sense if I'm wrong? That question defined his final and most vital step in the checklist, the margin of safety. He believed no investor, no matter how skilled, could predict the future with precision. Business conditions change, industries evolve, and management decisions can disappoint. So instead of trying to forecast perfectly, Graham built a cushion, a buffer between what something is truly worth and what you pay for it. That buffer was the margin of safety. He explained it simply. If you calculate a company's intrinsic value at $100 per share, you should aim to buy it at 70, 60, or even less. That difference, that protective gap, absorbs the inevitable errors in your judgment, It's the difference between speculation and intelligent investing. The purpose of the margin of safety, Graham wrote, is to render unnecessary an accurate estimate of the future. This idea wasn't theory. It came from bitter experience. During the 1929 crash, Graham watched highly rated companies collapse overnight, their supposedly safe valuations proving meaningless when markets panicked. He vowed never again to rely solely on forecasts or faith. From then on, he insisted on buying only when a stock's price left plenty of room for error, when the downside risk was limited and the upside remained meaningful. One of his favorite examples was the net stock, a company whose market price was less than the value of its current assets minus all liabilities. In other words, you could buy the entire business for less than its liquidation value. To Graham, these opportunities were rare gems, low-risk, high-potential situations where even a conservative investor could act boldly. In today's market, such extreme bargains are harder to find, but the principle remains vital. A modern investor can still apply it by demanding that every purchase come with a clear discount to intrinsic value. Whether you're buying a growing tech company, a dividend-paying utility, or a cyclical manufacturer, the principle holds. Leave room for uncertainty, because in markets, uncertainty is the only certainty. The margin of safety also has a psychological side. It protects investors not just from losses, but from themselves. When markets fall, those who bought with a margin of safety can stay calm, because they know they purchased with discipline. Those who chased prices, on the other hand, are left at the mercy of emotion. In Graham's mind, this discipline was the defining line between the speculator and the intelligent investor. The speculator bets on the future. The intelligent investor prepares for it. He famously compared investing to engineering, as in the quote at the beginning of this chapter. The margin of safety is always dependent on the price paid. It will be large at one price, small at another, and non-existent at still another. Just as an engineer builds a bridge to hold far more than the expected weight, an investor should build a portfolio that can withstand far more than the expected strain. And here lies the beauty of Graham's checklist. Every step leads logically to this moment. The balance sheet shows financial strength. The earnings record shows stability. Valuation measures reasonableness. Management reflects stewardship. But the margin of safety ensures survival. It is the final guardrail between risk and ruin.
In our age of instant data, algorithmic trading, and flashy financial headlines, Graham's message feels almost radical in its simplicity. Buy with discipline, demand a cushion, and never assume the market will be kind. The intelligent investor doesn't try to eliminate uncertainty, he prepares for it. As I reflect on Graham's checklist, from analyzing financial strength to judging management, and insisting on that final buffer of safety, I'm reminded that his wisdom isn't confined to the past. It's a living philosophy, as relevant today as it was when he first wrote it. Because while markets evolve, human behavior does not. Fear and greed still drive prices, and discipline and patience still determine success. In the end, Graham didn't just give us a checklist. He gave us a compass, a way to navigate markets with clarity, humility, and reason. And for those willing to follow that compass, the rewards, though sometimes slow to arrive, are the kind that endure. That, I think, is the greatest lesson of all. Investing intelligently is not about being brilliant, it's about being prepared. And that preparation begins, always, with Graham's timeless checklist.